I'm Andy Panko, owner of 10 in Financial. Welcome to Retirement Planning Demystified. This video will address what you need to know about the simplest form of annuity, an income annuity. And be sure to watch to the end where I discuss when an income annuity may be a good decision for you. Annuities are often misunderstood. That's because there are different kinds. Some are very straightforward, like an income annuity, while others can be highly complicated and confusing, like variable and indexed annuities. To learn more about those, check out my other videos, what is a variable annuity and what is an indexed annuity. Before we start, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. There are three general types of annuities: income, variable, and indexed. And for each of these three types, there are subtypes of immediate or deferred. In a nutshell, an income annuity is when you buy a lifetime stream of guaranteed income payments from an insurance company. You can sort of think of it like a traditional pension, but one you buy with your own money, unrelated to any of your employers. In its simplest form, an income annuity is where you give an insurance company a lump sum of money called premium, and in return they give you a fixed monthly payment for the rest of your life. Those payments are the income in income annuities. When buying an income annuity, you can also choose when you begin receiving your payments. If you choose to start receiving them within a year of paying your premium, that's called an immediate annuity. Another common name for this type of annuity is a SPIA, or single premium immediate annuity. If you instead choose to start receiving payments more than a year after paying your premium, that's called a deferred income annuity. Another name for this is a DIA, or deferred income annuity. With an immediate income annuity, it's very important to keep in mind that once a short initial grace period is passed, you generally cannot get your premium back. You're locked into the annuity contract for life. The grace period is called a free look period. Depending which state you're in, the length of the free look period may differ. It starts when you sign your annuity contract and typically lasts for 10 days, though some states may allow more or less than 10 days. During this period, you can walk away from the annuity and get your money back in full, no questions asked. But once your free look period is passed, there's usually no turning back. So before buying an immediate income annuity, make sure you've done all your research and analysis and are confident it's the right decision for you. As for deferred income annuities, you do typically have better access to your premium, at least during the period between when you first paid it and when your payments ultimately begin. This is called the deferral period. You rarely have unrestricted access to your premium during the deferral period, but you are generally able to take out up to 10% of your initial premium per year without penalty. If you want or need to take out more than that, you have to pay a penalty known as a surrender charge. And then once your payments actually begin, assume your remaining premium is then locked in permanently and can no longer be taken out. Like with immediate income annuities, when buying a deferred income annuity, only consider it if you're absolutely certain it's right for you and you're willing to permanently part with your premium in return for receiving the payments. Buying an annuity is a legally binding contract between you and the insurance company, and like any contract, you need to fully understand its terms and provisions. Let's go through some examples. I'll start with an immediate income annuity. Assume you're a single female, age 65, and you choose what's called a life payout, which means payments will last until you die. Assume you decide to pay $100,000 of premium. Currently, on that amount of premium, you could expect to receive about $475 per month, which is about $5,700 per year for the rest of your life. The monthly payment you receive is driven by four main factors. First, obviously the amount of premium you choose to pay is important. All else equal, the higher the premium, the higher your monthly payments will be. Second, your age matters a lot. The older you are, the larger your payment will be. That's because the payments last for your whole life. Your life expectancy, and therefore the amount of payments the insurance company is planning on having to pay you, gets smaller as you get older. So pound for pound, the older you are, a given amount of premium will get you larger payments. Third, the current level of interest rates plays a big role. Insurance companies invest your premium in interest-bearing investments. When they make payments to you, some of those payments is a return of your initial premium, but some of it is also them passing on to you the earnings they made on your invested premium. When interest rates are high, the insurance company earns more on your invested premium, which means they can offer you a higher payment. But when interest rates are low, they earn less on the investments, which means they offer you a lower payment. And finally, your gender matters. Statistically, women have longer life expectancies than men. If you're a woman, the insurance company expects to have to pay you for a longer period of time than if you were a man. That means your monthly payments will be less than if you were a man. Let's go back to our example and see it in a graph. Here's a timeline out to age 90. Obviously, you may die sooner than that, or you may live beyond that, but for purposes of this example, I'm showing it to 90. The red bar is your initial $100,000 premium purchase, and then the green bars are your total payments each year of $5,700. You'll notice this looks pretty good if you live until 90 because you'll end up receiving a lot of payments. But what happens if you die early? That, unfortunately, is the main drawback of a basic income annuity like what's shown here. You're kind of taking a gamble on when you expect to die. Let's look at your cumulative payments for this example. These blue bars show how much you've paid or received in total for the annuity. In the first year, you pay $100,000, but then receive $5,700 of monthly payments, which means your cumulative payment the first year is a negative $94,300. And then each year, you get another $5,700 in payments. Eventually, as the years pass, you receive enough payments to have recouped your initial $100,000 premium purchase. In this case, you recoup your premium and break even around age 82. Then every year after that, you continue to get another $5,700, so you then have an increasingly larger cumulative gain in the annuity. And as you can see, the longer you live, the more you end up receiving. The best way to think about an annuity like this is that it's longevity insurance. In other words, it's helping ensure you don't run out of money if you end up living a long time. Think about life insurance. No one really likes paying for life insurance, and you hope you never need it, but you buy it for protection against dying early. You should think of an income annuity the same way. It's insurance. But unlike life insurance, which helps protect against dying too soon, income annuities help protect against living too long. Nonetheless, many people are hesitant to plop down a big amount of premium for fear they may die young, and the annuity will end up being a bad bet in hindsight. To help alleviate some of that concern, insurance companies offer a variety of payout options. Here are some of the more common ones. A life payout is what I used in this example. Your payments will last until you die, whether that's 2 months or 40 years after paying your initial premium. The next type of payout is a joint life payout, which is probably the most common form selected by married couples. Your payments will last until you die, at which point the payments will continue to be made to your spouse until he or she dies. If your spouse predeceases you, then payments stop when you die. Basically, so long as one of you is still alive, the payments will continue. The next type is what's called a life with cash refund payout. Payments last until you die, but if you die before receiving enough payments to repay the amount of your initial premium, your beneficiaries will be paid a lump sum equal to the amount of premium which was not yet repaid to you. This can also be done as a joint life payout instead of just a life payout. The best way to think about this is that if you don't live long enough to break even, your beneficiaries will be paid however much is necessary to get to break even. If you're single and don't have any children or other people you want to leave money to, then maybe you're not concerned about dying too soon and not getting to break even on your annuity. Because frankly, once you're dead, you're not going to care what happened to your money. In this case, maybe a plain life payout is fine. But if there are other people in your financial plans, these other forms of payout may be of value to you. Next is a period certain payout. Payments will be made for the length of a fixed period, such as 10 or 20 years. If you die before the end of that period, payments will continue to be made to your beneficiaries for the remainder of the period. Period certains can also be done as joint life. The benefit of a period certain payout is that you know the payments will last for a specified amount of time, whether you die before then or not. The downside is that once the period ends, the payments stop, even if you're still alive. To help alleviate that problem, there's also a life with period certain payout. This is a life payout, but with a minimum period certain, such as 10 or 20 years. If you die before the end of the period, payments will continue to be made to your beneficiaries for the remainder of the period. Unlike a regular period certain payout, even once a period ends, payments will continue until you die. This can also be done as a joint life as well. Let's see how the different payout options affect your payment. These numbers are based on our original assumptions: a 65-year-old female paying $100,000 of premium, and all quotes were taken as of May 18th, 2020 from www.immediateannuities.com. Now, I'm not specifically endorsing this site, but it's one of the few that gives free quotes without having to enter any personal or contact info. So I like using it for an estimation tool without having to worry about an annuity salesperson hounding me afterward to get me to buy something. Anyway, you can see our original monthly payment amount of $475 for a life payout. Instead, assume it's a joint life payout where your spouse is 3 years older than you. And I just randomly picked 3 years because it's close enough in age. In that case, your monthly payment decreases to $430 a month. It's lower than just a life payout because the payments are assumed to last longer, since the insurance company will pay you until you and your spouse die. If you wanted to do a life payout with a cash refund option, the payment would be about $435 per month. If you wanted just a fixed 20-year period certain, the payment would be about $520 a month. Now, that's a pretty good amount larger than the life payout, but remember, the period certain payments will stop after 20 years, even if you're still alive. And finally, life with a 20-year period certain would be about $435 a month. Now, just to show how age affects all this, compare all these payment amounts to what the payments would be if you bought and started this annuity at age 70 instead of age 65. Since you would then have 5 less years of life expectancy, all the payments would be larger except the 20-year period certain. And that makes sense because no matter when you die, the period certain is going to pay 20 years regardless. And instead, assume you buy and start the annuity at age 75. The payments all get even larger, except again for the period certain payout. The payment amounts increase exponentially with your age because as you get older, your life expectancy keeps getting shorter, which means the insurance company expects to have to make a smaller number of payments to you. Let's now look at an example of a deferred income annuity. The only real difference from an immediate income annuity is that a deferred income annuity allows you to start receiving payments at some point in the future, specifically more than a year after paying the premium. We'll assume the same facts as before: single female, age 65, with a life payout and $100,000 of premium. Let's assume you choose to start payments in 10 years. Currently, you could expect to receive about $925 a month, or about $11,100 per year, when payments begin in 10 years. As you can see, this monthly amount is significantly higher than the $475 per month you'd get from an immediate annuity. That's because you're not actually starting payments for 10 years. So when you do start, you have 10 less years of life expectancy than if you started today. Therefore, the insurance company will pay you more each month because they expect to have to make a smaller number of payments to you. Also, between when you first buy the annuity and when your payments begin, the insurance company invests your premium. In that time, the invested premium grows, so that when you do start getting payments, your premium will ultimately be something larger than $100,000. All else equal, that also means bigger payments. Let's see this graphically. Like in the immediate annuity example, the red bar is your premium purchase of $100,000. The green bars are your monthly payments of $11,100 per year. And you'll obviously notice you get no payments from the time you buy the annuity at age 65 to when you start receiving payments at age 75. The blue bars again show your cumulative payments. You can see it takes a while to recoup your $100,000 of premium. Specifically, the break-even in this case is around age 83, which is about a year later than with the immediate annuity. Now, does that mean a deferred annuity is inherently worse than an immediate annuity? No, not necessarily. If you end up living well into your 80s or beyond, the deferred annuity will ultimately pay you more. But if you die young, then yes, the deferred annuity is likely worse. Like virtually every insurance product, it's impossible to know which option is going to end up being the best outcome for you. If you know with certainty when you're going to die, it would be real easy to figure out what's best. But most of us, unfortunately, don't have that level of foresight into our futures. I'd like to make a few other comments about income annuities. First, always remember income annuities are insurance and not investments. It's unfair to compare income annuities to traditional investments like stocks or bonds because it's not an apples-to-apples comparison. With traditional investments, you can sell them to get your money back. With income annuities, you give up the use of your premium once you hand it over to the insurance company. But in return, they guarantee to pay you for the rest of your life, even if that's 30 or 40 years. No stock or bond guarantees income for life. Insurance companies take on a lot of risk in committing to a potential multi-decade obligation, and that level of guarantee and commitment comes at a cost. Part of that cost is committing your money to them. Also, insurance companies have to invest your premium conservatively to ensure they don't lose so much of it that they won't be able to meet their payment obligations to you. And there are strict regulations which require them to invest conservatively like that. Insurance companies can't be too risky with your premium even if they wanted to. On the other hand, if you instead invested your money in a portfolio of stocks and bonds, chances are over a few decades those investments would perform better than the implied interest you would get from buying an income annuity. But you're also taking a lot of risk with that portfolio of investments. When you buy an income annuity, you're shifting all the investment risk to the insurance company. No matter what happens to the stock or bond markets, you'll continue getting your guaranteed payments for life. There's a tremendous amount of safety, stability, and certainty with income annuities, but those all come at a cost. Stocks and bonds don't offer that same level of safety, stability, or certainty. So again, it's not fair to try to compare income annuities to traditional investments because they're not. As for the fees in buying an income annuity, there aren't any outright fees per se. What I mean by that is you won't separately have to pay anything to buy it. You pay the initial premium and you receive payments. That's it. But income annuities aren't free. The insurance company and the person who sold it to you are getting paid, rest assured. However, their compensation is indirectly worked into the economics of the annuity. In other words, they essentially keep some of your premium and interest it earns while it's invested. You can kind of think of it like how banks make money on savings accounts. They don't necessarily charge you an explicit fee to open or maintain the account. Instead, they indirectly charge you by keeping some of the interest behind the scenes. They pay you less interest than what they earn. This is called an interest rate spread. They keep that spread as their compensation. Income annuities are kind of the same. As for how annuity payments are taxed, well, that depends what kind of money you use to buy it. If you purchased an annuity inside an IRA or any other form of tax-deferred account where you have not yet paid taxes on the money, all of your annuity payments will be 100% taxable when you receive them. If you instead buy the annuity with after-tax money, a portion of your annuity payments will be taxable and a portion will not. This is because a part of each of your payments is a partial return of your initial premium. The other part is interest on your premium. The portion of your payment that is considered a return of your premium is tax-free, as it's basically just giving you back your money that you already paid tax on before you used it to buy the annuity. The interest portion of your payment will be taxable. If you live long enough to eventually recoup your entire premium, all your subsequent payments are then considered interest and will be fully taxable. Annuity taxation can get real confusing real fast. Thankfully though, the insurance company from where you buy your annuity will tell you each year how much of your payments are taxable and how much is not. You won't have to do the calculations yourself, thankfully. Lastly, only buy annuities from highly rated insurance companies. Keep in mind you're buying something that has a potential multi-decade long financial guarantee behind it. You want to do your best to make sure the insurance company behind that guarantee is actually going to be around the whole time to make good on your payments. There are independent companies that rate the financial strength of insurance companies. One of the most respected is AM Best. They have a rating scale that ranges from A++ to D. You only want to consider buying annuities from the insurance companies that are the strongest rated and therefore the most likely to be able to fulfill their obligations to you. Specifically, only buy from insurers whose ratings are in the single A range. Don't buy from anyone below that. So, when should you consider buying an income annuity? There are a few things to think about. Unfortunately, there is no universal answer. Like almost all financial decisions, this decision needs to be made in the context of your broader financial plan. But nonetheless, here are a few important things to keep in mind. First, only ever consider buying an annuity if you have a need for stable and secure guaranteed income. For example, if your expected annual expenses in retirement are $60,000 per year, and you already have more than that coming in from Social Security and pensions, then you have no need for any annuity of any sort, because you have no need for additional secure income. But if you only have, let's say, $40,000 of Social Security and pension income per year, Then start to think about how you're going to generate the extra $20,000 of annual income you'll need each year. If you have a lot of investable assets that can easily, safely, consistently throw off $20,000 per year, then you probably shouldn't consider an annuity. But if you don't, then maybe you should. Also, how much of your $60,000 of expected expenses are absolutely necessary versus discretionary or fun spending? Generally speaking, you probably want to make sure all your necessary expenses like food, housing, transportation, utilities, and taxes are covered by lifetime secure income like Social Security, pensions, and annuities. Because you don't want to risk running out of money and not being able to pay those things. But I don't think you have to cover your anticipated fund spending with the stability and security of annuity income. Next, consider how risk averse you are. If you're the type of person who loses sleep over seeing your accounts fluctuate in value, then maybe you should consider the certainty and guarantee of an annuity. Statistically speaking, investing in diversified portfolios of stocks and bonds is likely to have better long-term financial results than buying an annuity. But there's obviously a lot of risk in traditional investments, and they will go up and go down over time. With an income annuity, you know with certainty what you're going to get and when you're going to get it, but that guarantee and stability comes at a cost. If you want to avoid risk as much as possible, then that cost could very well be worth it for you. Finally, you have to give consideration to your legacy plans or what your desires are to leave money to your children or other heirs. In most cases, income annuities stop when you die or when you and your spouse die. With income annuities, there generally isn't a lot left, if any, that ends up going to your beneficiaries. So if one of your main goals is to maximize the amount of money you leave to your heirs, an income annuity may not be right for you. But on the other hand, if your goal is to maximize your own security and income in your retirement, and you're not necessarily trying to leave a lot of money to your heirs, then an annuity makes more sense. Well, that's it for my summary on income annuities. I hope you enjoyed it. Don't forget to watch my related videos, what is a variable annuity and what is an indexed annuity. Both variable and indexed annuities are fairly complex. They both start on the chassis of a basic income annuity, like what was discussed in this video, but then they add on all sorts of fancy bells and whistles. I think you'll find those videos really interesting. If you haven't already, subscribe to this channel so you can be the first to know when new videos are posted. And don't forget to subscribe to my monthly newsletter, Retirement Planning Insights, which provides informative retirement planning tips and info. Also, be sure to join my free Facebook group, Taxes in Retirement, where you can get answers to all your retirement-related tax questions. Thanks for watching. I'll see you soon.